Welcome to the Beat of Business. This is your morning business news update for Friday, May 7th, 2021. Let's start with the jobs report. U.S. job growth unexpectedly softened in April from the prior month as employers found it difficult to attract workers, a development that's holding back momentum in the labor market. The U.S. economy only added 266,000 jobs in April, which is well below the forecast. In fact, economists in a Bloomberg survey projected 1 million new jobs being added to the economy in April. With less than stellar numbers, unemployment has edged up to 6.1% from 6%. The disappointing numbers leave overall employment well short of its pre-pandemic level and is actually pretty consistent with the recent comments from company officials that highlighted the challenges of filling open positions. Bank of America U.S. economist Joe Song said, quote, "A big segment of the workers are still concerned about the pandemic. We estimate roughly 1.6 million workers want a job, but didn't look for a job recently because they were still concerned about contracting the virus or other factors around the pandemic," close quote. He goes on to say that many potential labor force participants are citing that childcare is still a big factor for their decision not to participate in the labor market. Others believe this could be due to the enhanced unemployment benefits and the latest round of pandemic relief checks, which could be discouraging people to return to work even as job openings approach a record high. The Federal Reserve released its latest semi-annual financial stability report, and in it they cited particular examples where certain assets may be vulnerable to significant declines should the risk appetite fall. Now, they were particularly concerned about the episodes of high trading volumes and price volatility for the so-called meme stocks. Now, in the report, they also singled out hedge funds over their slightly higher than normal leverage. But the financial stability report that the Federal Reserve released also has some good news. The Fed mentioned that banks remain well capitalized and household debt is manageable. They also mentioned that leverage is generally low among broker-dealers, and with interest rates remaining low, businesses are better able to service their debt obligations as earnings recover. In other news, it's been a crazy week for Peloton and its investors. The company sells high-end exercise bikes and treadmills that cost well into the thousands of dollars. The company was one of the more popular stay-at-home stocks, and its share price and popularity really took off during the pandemic as consumers sought the convenience of at-home and on-demand workouts. Now, this demand sent shares of the company up 434% in 2020 alone. Now, this whole recall episode started back in March when Peloton CEO John Foley disclosed that a child had died in an accident involving one of its treadmills. At the time, Peloton challenged all recall requests, saying that children, pets, and objects need to be kept away from the treadmill at all times. But the U.S. Consumer Product Safety Commission subsequently issued a warning for the device, citing 39 incidents and saying that the devices pose a serious risk to children for abrasions, fractures, and death. Now, since the notice from the Product Safety Commission on April 19th, Peloton shares tumbled 22% to $83 a share and plunged even further Wednesday after the company decided to take action. Now, according to the Product Safety Commission, consumers who have purchased a treadmill should immediately stop using it or contact Peloton for a full refund or other qualified remedy. In vaccine news, the world is becoming more reliant on China for vaccines as India's raging virus outbreak has stifled its ability to deliver on supply deals. Now, over the past few weeks, leaders from nations around the world have sought more shots from China despite concerns about their effectiveness. Now, demand is expected to rise even further with the World Health Organization's expected authorization of vaccines from two Chinese vaccine makers, Sinovac Biotech and Sinopharm Group. This authorization from the World Health Organization would allow developing countries in Asia, Africa, and Latin America to access the vaccines through COVAX, the global vaccination effort. Now, China has become the largest exporter of COVID-19 vaccines around the world, and in many countries, it has become the only option. With India trying to manage its own COVID outbreak and the United States being preoccupied with its domestic vaccination push, China has become the most reliable vaccine supplier in the world. Now, in response, President Joe Biden has thrown his weight behind a movement to waive patents on domestic COVID-19 vaccines, which would allow other companies and other countries to manufacture them. Now, even with that, China has already shipped out 240 million doses around the world, which is more than all other nations combined. Speaking of vaccines, the Wall Street Journal published an article this morning stating that vaccine administrators across the country are running short on special syringes needed to extract every last dose of COVID-19 shots from vials. Now, the shortage of these special syringes means that in some cases, up to 17% of the Pfizer vaccine and up to 13% of the Moderna vaccine end up being wasted. Also from the Wall Street Journal this morning, supply chain issues continue to be a problem, particularly between grocers, restaurants, and their suppliers. Now, the friction between food retailers and their suppliers is adding costs to the food chain, which impacts just about everyone in the country. Now, food makers and distributors are blaming labor shortages, raw material shortages, and high freight costs. But many retailers don't want to hear it. In fact, Walmart is starting to fine suppliers over infractions like late or incomplete orders. In other financial news, David Swenson, the man who led Yale University's endowment fund from 1985 to 2021, passed away at the age of 67 on Wednesday night. Now, he is credited with changing the course of institutional investing forever, and he grew Yale's endowment from $1 billion when he started in 1985 to $31.2 billion in 2020. Now, he was a pioneer in terms of university endowments, and he inspired a generation of investors with his approach, and he groomed many proteges who went on to run endowments at other major universities and foundations. At the time of his hiring in 1985, the endowment paid for about 10% of the university's operating budget, and today it pays for more than a third of its operating budget. And the endowment fund literally pays for everything from faculty salaries to financial aid for more than half of Yale students, and that financial aid effectively subsidizes the cost of tuition at Yale. That's today's morning business news update from the Beat of Business. Thank you all for watching. I'll see you all next time.